people sit down and they're so proud they have $1 million in their 401k, and I'm like, you really don't. I'm like, but it says $1 million. I know you do, but you'll never see $1 million out of that as it is right now.
If you made $100,000 and you contributed $20,000, your taxable income for that year is $80,000. 1944,
yep.
The federal tax was 94%, was the top marginal bracket.
You can spend money better than the government.
Yes, this is our underlying belief. So in today's video, we're going to talk about something terrible happening in your 401k.
Oh, no.
Look, this is a little dramatic, guys. Okay, but this was the suggested title. Look, it's taxes. Okay, so someone sent us an article about from Ed Slott that was talking about. He was saying, hey, this is a huge problem. Blah blah blah. We're going to get into that in just a moment.
Okay.
But this is important is, after years of planning retirements, planning estates, hundreds of different folks all across the country, the big unaddressed issue is taxes. There's a couple tricks and there's a couple reasons why that's the case, and we're going to talk about them in this video.
Yeah. It's funny, people sit down and they're so proud they have $1 million in their 401k, and I'm like, you really don't. I'm like, but it says $1 million. I know you do, but you'll never see $1 million out of that as it is right now. Stinking Uncle Sam's your big big partner. Yep.
It's tough to think about it. So that's what we're going to talk about in this video. Someone sent us this article. We wanted to make a video about it. So by the end, you'll understand what's really happening in your 401k, and we'll share a powerful but pretty common strategy to help you to reverse it before it's too late. Okay. Yep. It's not bad news all across the board, but if we don't get your attention, you might not take action. Okay. So our goal is to help you to save as much as possible. And so let's dive right in. So this article, August of 24, there's tons and tons of these. Okay. These come out all the time.
All the time.
But they interviewed, Ed Slott, who is the IRA guy across the country. He's the man. So, and frankly, I appreciate his stuff and his perspective. And so they wanted to talk to him, and what he was talking about is the ticking time bomb in the 401k, which is of course deferred taxation. Okay. And so we want to talk about this and how this works. If no one's explained this to you, I'm going to try to explain it to you in the simplest way possible that you'll understand. When you contribute to a traditional IRA or 401k, two things happen. Okay. One, you are deferring the tax. You're deferring the income. Okay. And so you get a tax deduction in the current year. If you made $100,000 and you contributed $20,000, your taxable income for that year is $80,000. Yep. Don't get mad at me. That's a simplified example. Okay. Sure. So you're doing two things. You're deferring the tax. You did not pay income tax on that chunk of money. You defer the tax. The second thing you do, this is where the magic happens, in my opinion, is you defer the tax calculation. And I think this is really, really clever. Now, there's actually something in the article that Slott says that I slightly disagree with, so we'll talk about that. But what most folks forget or didn't realize is that they're deferring the tax calculation. They don't know exactly what the amount of tax is going to be when you take it out. Todd, to your point, if you have $1 million in the 401k, well, you probably don't, because you got to pay taxes on that.
Yeah.
And so you have a minority partner in that account. That minority partner is Uncle Sam. Our friends in Washington, as we say around here. But they're making majority partner decisions. They're deciding what their cut of your 401k is. And here's the final kicker on this is it's variable. It's variable based on the time that you take it out, what the tax rates are, what your income situation is like. And so when we talk about this kind of stuff, it sounds a lot simpler than it actually is in practice. There's a lot to think about. So we'll talk about some of the key issues here. So the other problem with the ticking tax time bomb here is that we're in a really low tax environment right now.
It doesn't seem like it.
I was going to say, it probably doesn't seem like it.
It doesn't seem like it, but we have graphs showing back in the, 20s and 30s?
Well, the highest was 1944.
Yep.
The federal tax was 94%, was the top marginal bracket.
Jeez.
Yeah.
Yeah. That's a big tax.
So there's two parts to this conversation. So one is, we are in a time of relatively low marginal tax rates. Okay. Now, compared to where we were in 2017, we're lower for most people. Okay. Depending on what the current administration does at this time, that we're recording this is early 2025. Okay. So if something crazy happens and it changes, don't get mad at me because of what I'm saying now. But currently, what's going to happen is the tax system that we're under is going to sunset. back to 2017,
Mhm.
regardless of whether or not Congress does anything. Let me say that in a different way. Unless Congress acts, we're going to revert back to the last tax system. That will be a tax increase for most Americans across the board. Sorry, it's just the truth. And so we want to look at this and go, okay, well, we want to pay taxes in the lowest bracket. That's always the rule.
Mm-hmm.
How can we pay it as low as possible? The place that people get caught with 401ks is the idea is that you're going to be in a lower tax bracket in retirement.
Mm-hmm.
But unless you're proactive, that may or may not happen. What we're seeing, especially with our baby boomer clients, I'm not being mean to baby boomers, it's a generational thing. They tend to spend more in retirement than they did when they were working in their later years.
Yeah.
Because, and this is actually something I love about baby boomers, they want to enjoy it and they want to spend their money that they've saved.
Every day Saturday.
Yeah, and that's great. That has compounding tax problems if we don't address them. Okay. Now, the argument against the fact that we're in lower effective rates right now is that in the 70s, tax rates were higher marginally, but there are a lot more loopholes than are available today.
Right.
There's some truth to that, but that's a little bit of a cop-out, I have to say. There's a lot of opportunity now in the tax code to be very flexible and to save quite a bit of money. And so that, just because there were more loopholes in the past doesn't mean we shouldn't be proactive about what we're doing now.
Sure.
I'm sure that this probably came as a shock to you because we've been told by our employers, the internet, even our peers and friends that maxing out the 401k is the best plan for your retirement.
Yep.
Now, if you're concerned that your plan is headed in the wrong direction or want to talk about some better ways to efficiently use your 401k, click the link below, send us a few details, and we'll send back a personalized video that walks through with your actual numbers how to fully optimize your 401k withdrawals during retirement, plus a whole lot more. So we're going to give you some ideas about how to make some changes on your specific situation. And I want to point out too, Todd, anytime we're getting cookie cutter advice from someone who doesn't know our exact situation, it's always suboptimal.
Always.
Every time. And so we're not giving you advice when we share this info with you, but we're giving you some ideas about how you can start to think about this in a little bit of a different way. Some of the mistakes that we see that people make is contributing everything either into a pre-tax 401k or IRA, or one that I see a lot more with high earners is everything into a Roth. This is a little bit counterintuitive. Even the article that we were sent was like, hey, all in on Roth. And I'm like, okay, I appreciate that. Yes, Roth is great. However, what's the problem we're trying to solve? We want to pay as little tax as legally possible, right? So if you're in your peak earning years and you happen to be earning in the top bracket, what we're trying to do is not pay taxes in the top bracket. So why would we do that to put it into the Roth?
If you're funding the Roth, you pay taxes as you put it in there. And so if you're at the highest rate, that's not, again, cookie cutter information is not always the best.
Right direction, wrong strategy. And look, that might only cost a couple $100,000 over your lifetime. So what's $1 million between friends, right? That's what I always say to Todd. But just kidding. So this is the way that we want to think about this, though. We want to defer tax that's in a certain bracket based on your situation. We need a tax plan. At what rate are we going to defer tax, and at what rate are we going to pay the tax? And this sounds really simple, and it is simple, but we have to understand your situation. What a lot of folks that we talk to, especially if they're charitably inclined or have a business, they're really shocked that if we plan well, this is proactive planning, this is advanced planning. If we plan well, we can defer tax today, this year, get a tax deduction on this in this calendar year, convert those dollars to a Roth, and in some cases pay $0 in tax. So rather than, you paid the tax and it can grow tax-free, that's good. Better would be we pay tax at a lower rate and it grows tax-free. Great. Best would be we get a tax deduction and we pay $0 in tax and we let it grow tax-free. And it's not magic. It's just we have to plan and do some strategies. And so, number one, if no one's ever talked to you about that, that's a problem. But number two, it has to be personalized to your situation. And so, if you're wondering whether or not that you may be a candidate for that, click the link below, fill out the quiz. send us a bit of information, and we'll tell you whether or not it makes sense that you potentially would be a candidate for that strategy. But I mean, that's dynamic, Todd.
It is,
in my opinion.
It's huge.
If I can,
I like how I've just sat here and listened like our listeners. I mean, this is what you're really good at, and this is what you're extremely passionate about. And so if you're always out there thinking, what's Todd doing? Well, I'm listening just like you are. So this is Ian's big thing, and I'll let him go. So
I appreciate that. But it's always a win for me.
It is.
If we can make sure that the money that you're going to spend in retirement or goes to the kids or whoever you want it to go to can grow tax-free. We can disinherit our friends in Washington in a legal and 100% compliant way. That's a really big deal.
You can spend money better than the government.
Yes, this is our underlying belief. So a couple other things that we want to talk about that we haven't talked about yet that I want to address in this one. There are a couple of extra traps in deferring and delaying the tax that a lot of folks don't realize. Number one is the tax on Social Security.
I hate that.
This is a tricky one. Yeah, this is a tricky one. When I tell people this, when we do educational events or even in meetings, like the air comes out of the room and I feel like it's my fault personally. And so I want to be clear. I did not pass the legislation.
Why did you cause that?
I wasn't even alive when that happened. Okay. But the truth is, your Social Security is going to be taxable based on your combined sources of income. Okay. So that includes your IRA, 401k distributions, capital gains, qualified dividends, municipal bond income. This is a fun one. Stump your advisor. Ask your advisor if municipal bond income is taxable. It could cause other taxes. So this is kind of a tricky one. So all of your income gets lumped together plus half of your Social Security. And if that number is over a certain threshold, the threshold's really low, $44,000 if you're a married couple, then up to 85% of your Social Security will be included in your taxable income. You're not going to be taxed at 85%, I want to be clear, but that will be included in your taxable income. And that could be extra tax on, that tax could be $10,000 a year, depending on your tax bracket and your other income. And so let's say over 10 years, $10,000 a year over 10 years, that's $100,000 in taxes over your lifetime. So what if we thought about it differently? And not even is that just a reduction in your Social Security benefits and money you don't have to pay if we plan potentially, but what if you had invested that money over that time period? Or what if you had spent that money? Or what if we looked at it and we said, hey, what if we took that same $100,000 and disinherited the government with a strategic plan over a couple of years?
Love that idea.
That's an interesting idea. So that's one thing there's kind of a hidden sort of trap that folks don't realize. The other one is IRMA. Our friend Irma. So if you're watching this and your name is Irma, we're not mad at you. Okay. Yeah, it's just, this is what it's called. Okay. IRMA, this one gets people's blood boiling. I mean, Social Security kind of makes people mad. They're like, okay. But IRMA, like people freak out about IRMA. And so IRMA is, if you didn't know this, IRMA is the surcharges on your Medicare. So if you earn too much money, from the IRS's perspective, regardless of where that money comes from. So that's your, it could be your Social Security. It's based on your modified adjusted gross income for the nerds out there. But if your RMDs, the money you're being forced to take out of your 401ks, is above a certain threshold, your Medicare premium is going to be higher. And it's based on the 2 years previous.
It's substantially higher.
It could be substantial. I mean, this could be, $12,000 a year per couple. I mean, it's not a small amount of money, right? And so, again, over 10 years, what does that add up to? So let's say your Social Security and IRMA, that could be $20,000 a year for your retirement.
Yeah.
Even just over 10 years, that's $200,000.
Right.
But you've just figured out how to no big deal, right? Anyway, so this is another trap that we help folks with is figure out, okay, at what point are you going to be subject to IRMA? If you are, and what if we could, handle some of that tax now so that you're not subject to IRMA?
It'd be nice.
These are the advantages of planning, Todd.
Well, I mean, it just goes down. You need a professional. This is not a DIY type thing. You could spend years trying to figure that out, or you could just sit down with us and we'll explain it to you.
Yeah, and what's that? What's your time? What's your time worth? I love working with DIY people. We do flat fee planning for them all the time. There's always an opportunity.
Sure.
I've literally never come across a situation where they had everything figured out. And so the question is, when do you want to know that you've got a blind spot? When do you want to know that there's something that we can do to optimize it?
Right.
Would have been nice 20 years ago, but second best is now. Look, as you can see, large 401k balances, if they go unaddressed, they can force you to pay insane amounts of taxes that are unnecessary during your retirement. So to help you to keep more of your hard-earned money for retirement, we're going to show you how we helped a client use a tax strategy, just like the ones we talked about, that you can start using right away. So look, this is actually really simple, but it's not about how much you have in retirement, it's how much you keep. That's really, really what it comes down to. So I want to talk to you about a client. Let's say they were 55 in this example, okay? This is real scenario. I'm changing a couple of the details to protect the innocent, okay? 750 in IRAs, 401k, and they wanted to know, okay, how do we, number one, when can we retire? What's our income going to be? But also, okay, how do we handle this tax thing? This is a pretty common situation that we have. So they had a few years left in their journey to retirement, so they were still contributing to their 401k. But they had been contributing all to Roth. So the first thing we did, this is going to sound counterintuitive, based on their situation, we actually switched that to traditional.
It makes sense sometimes.
And so hang with me. So yes, we're growing the deferred bucket of taxes, but in their situation, they had a plan, so this made sense. Okay, so we deferred into their traditional, not into their Roth, and they also were saving in a brokerage account outside of their 401k. All right, so they had enough money over there, about $400,000, that they could cover some day-to-day living expenses and had a little buffer for retirement. They felt they were on track because they've been contributing pretty aggressively the last few years, but they had been told that taxes wouldn't really be an issue for them.
Sure.
And so we ran the numbers, we did some projections, we created an income plan and a tax plan for them. And what we found is that if the tax situation went up or if it even stayed the same, they were going to pay a lot more in lifetime taxes than they thought, to the tune of a little over $2.5 million based on their spending.
That's real money.
Whoopsies.
Yeah, whoops.
No big deal. So their current advisor, their strategy was, hey, we'll defer and delay. We don't want to worry about it. You have plenty of money. You're never going to run out. And so I love hearing this. This is what people tell us their advisors say. You have plenty of money. You're not going to run out. So let's not worry about the tax thing. We'll deal with that later.
Sure.
Okay. Well, if you're at home listening and you ask your advisor, hey, I'm really concerned about taxes, and they say, don't worry about it. You'll be fine. We'll deal with that later. Does that give you comfort? I want you to think about this. Like, does this feel like a good strategy? Like we'll just stick our head in the sand and hope everything works out.
Sure.
It's fascinating to me that people get by with this, but anyhow. And so what we did is we created a plan to proactively pay those taxes. Okay. And so by addressing the tax situation early, we did strategic Roth conversions. We were able to use the money that they saved in their current year to start to pay for Roth conversions. Okay. So in their situation, they contributed, let's say it was $25,000, just to make the math easy, into the 401k in their last, 7 years of working is the plan, right? And in their tax bracket, they're in, effectively it's about a 30% effective tax rate. So that's going to save them, $10,000, $12,000 a year. Okay. Now every single year they've saved that amount. We're going to use that amount to cover the cost of conversions. And you're saying, wait, Ian, we're putting more money in and then we're converting. Why wouldn't we just put it in? Because the amount that we can convert with that same amount of money is larger than if we just contributed that directly. Okay. And we have money outside that we can contribute more. And so we made a plan based on their tax bracket, based on where they are. Hey, anything above the 24% bracket, we're going to defer that, which is exactly what we did. But under that 24% bracket, we're actually going to pay the tax and convert that. Now that sounds like a ton of work and it sounds like, oh, that's a big hassle, and it's counterintuitive. Well, when we do the projections at a very modest rate of return, it's a difference of about $1.75 million over their lifetime. Now, that's not taking into account the tax increases or potential IRMA brackets. And so that's just their savings on Social Security. And so those other savings are going to stack up in other ways. But just the difference between converting early or converting later on when they actually didn't need the money and it was going to be forced taxation was almost $2 million in savings. And so let's say that we charge, and I don't even remember exactly what we charge the client. Okay, but let me just pull a number out of thin air. Let's say we charge $25,000 to do that. Sounds like a ton of money, right?
It's expensive.
The ROI on that is what?
Yeah.
100 times?
Yeah.
I don't know. I can't do that math in my head. I can do a lot of math in my head, but not that much.
Yeah.
And
2.5 million. Yeah. That's 100 times.
It's a ton of money. And so I'm not saying that that's going to be an exact situation or even exactly what we would charge. We would charge far less than that, very candidly, right? But even if that was the amount that we charge to get that done, the ROI is incredible on that. And so planning has a huge ROI. And I just don't want people to overlook that. The final piece that I want to say on that is what's interesting is, for me, this is technical. For the client, this is emotional. And I don't want it to come across that I don't care about my clients. I care deeply about my clients. We literally this morning, we teared up in a meeting with clients today. It was after you left the meeting, but we care deeply about our clients and their goals, and that's really important, and the stuff that's going on in their life. But because we're an independent third party, we have the ability to look at their situation a little bit more clinically, and sometimes that's a big benefit. But this particular client, this was an emotional thing for them. The way that they felt when they found out what the tax bill was going to be, those aren't always fun meetings to talk about, because they've thought everything's fine for the last 25 years and we'll be good. And we just need to get to this number. And so those are sometimes hard conversations to have. But when we put the plan in place, when we show them what we can do, exactly the steps that we're going to take and how much we can save, it's like you can see the relief, what appears to me to be the relief coming across their face. And based on what they're doing now, they're spending more intentionally, they're saving well, they seem like they're enjoying their work a little bit more. They may work a little bit longer, I think, in this particular case, actually, because they're not worried about this stuff anymore. And so when you create a plan and you delegate some of the worry to professionals, you can enjoy your time a lot more. And so that's a huge piece.
Well, we've seen two types of people. Some people come in and they know it's a problem, but they don't know the solution.
Yeah.
And once we work with them, we give them a solution, just like you said, they walk out going, finally, this is taken care of. This has been on my mind. I've been worried about it. And now it is taken care of. The other people don't know it's a problem. And they walk in, and once they learn, oh, dang, this is a problem. Now it's being fixed. And they too walk out saying, I didn't know there's a problem. I've not been worried about it, but I now know it's fixed and I don't have to worry about it. It's they tell us it's a huge emotional relief to know, wow, I feel good about it. And they can proceed knowing things are taken care of.
I love it. It's, the satisfaction of being able to walk through this stuff with folks and really empower them to approach retirement, with vision and with clarity it's worth it. It's worth the hassle, So anyway, I wanted to kind of share that side of things. So we've peeled back the onion a little bit, and we've talked about some of the, potentially a harsh truth about what's really happening in your 401k. But we also talked about how we can reduce your tax liability by leveraging some creative Roth contributions and conversions. However, we know that these strategies they're complex, and it's crucial to avoid mistakes along the way. I am dramatically simplifying how this works. And again, we're not giving specific, tax, legal, or investment advice. This is for educational purposes. Okay. But this is why we created the free questionnaire to assess where you stand for retirement and really what steps you should be considering. It's not advice, but it's going to help you get a little bit further along and figure out where you need to focus. To your point, Todd, it's is there a problem? And then what's the roadmap? Or we know there's a problem. how do we fix it? So we'll send you a personalized video analyzing in our software, in our real software, your facts and situation, and show you really what the potential savings would be if you were to implement some of these strategies. And that'll give you some clarity about what steps to take next. So to get started, click the link in the description, and we'll see you in the next one.
See ya.